Today on Real Estate Backstage, legislation is introduced to defund the CFPB. The Senate has confirmed Scott Turner to lead the Department of Housing and Urban Development. The United States has reached a deal with Canada and Mexico to delay the implementation of tariffs. And finally, inventory levels are normalizing across the country. Now, before we jump into today's discussion, if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, go ahead and subscribe to the channel. That way you don't miss any future episodes of the show. And if you're looking for the show notes with links to all the articles that we're going to reference in today's show, you can find that at realestatebackstage.com/episode 17. Now, just in case this is your first time watching or listening, I'm Michael Smith. I'm your host. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company providing real estate brokerage, property management, and insurance services, headquartered here in beautiful Greenville, South Carolina. All right, so I want to start today with the CFPB. So this is according to Inman. Quote, with Republicans now leading the House, Senate, and White House, a renewed effort is underway to essentially dismantle the Consumer Financial Protection Bureau, or the CFPB, an agency created by Democrats after the 2008 financial crisis to create safeguards for consumers against predatory lending. The CFPB holds authority to create and enforce rules regarding consumer financial products, including mortgages and credit cards. Although the agency was created by Democrats in an effort to protect consumers from abusive financial practices, it has continued to be viewed by Republicans as an unchecked power, since its funding comes directly from the Federal Reserve and not through the appropriations process. In the past, Senator Ted Cruz, a Republican from Texas, has introduced bills to dissolve the agency, but took a different tack on Wednesday in presenting a new measure, the Wall Street Journal reported. Senate Majority Whip John Barrasso, a Republican from Wyoming, and Senators Mike Rounds from South Dakota, Steve Daines from Montana, Marsha Blackburn from Tennessee, and Rick Scott from Florida joined Cruz in his new proposal. The legislation, unlike past proposals, does not seek to repeal the measure that created the CFPB, but instead suggests restricting the amount of money that the Federal Reserve could transfer to the CFPB to $0. The CFPB is an unelected, unaccountable, bureaucratic agency that has imposed burdensome and harmful regulations on American businesses, banks, and credit unions, Cruz said in a statement. It is an unchecked Obama-era executive arm, and the Federal Reserve should not be transferring funds to it. Enacting this legislation would save American taxpayers billions of dollars, and I call on the Senate to expeditiously take it up and pass it, unquote. So the CFPB was created in 2010 as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act. This, of course, was in the wake of the 2008 financial crisis and the subsequent Great Recession. And they are tasked with regulating mortgages, credit cards, car loans, really any type of consumer financial product. And Republicans have been trying to dismantle the CFPB for a while now. They actually tried this unsuccessfully during the first couple years of the first Donald Trump administration. Now, it's unclear whether or not the CFPB can actually qualify for the budget reconciliation process, since it receives its funding directly from the Federal Reserve and not through congressional budget allocations. So right now we have this thing in the Senate called the filibuster, and any major legislation actually needs 60 votes to pass, not just a bare majority of 51 votes. And so the way around that is typically through what we call budget reconciliation, where rather than changing the law in any dramatic way, they actually just reallocate money to or away from things. Now, Republicans view the CFPB as a classic example of government overreach. And that is partly because of the way that it does receive its funding directly from the Federal Reserve in quarterly distributions rather than through the congressional budget allocation process. The Consumer Financial Protection Bureau has recently brought enforcement action against a wide variety of companies, including Freedom Mortgage, Rocket Homes, and Vanderbilt Mortgage. We've talked about a couple of these on recent episodes of the show. However, almost all operations at the CFPB have temporarily been paused based on instructions from the Treasury Secretary. So this is according to RIS Media. Quote, Treasury Secretary Scott Bessent has ordered a widespread shutdown of operations Monday at the Consumer Financial Protection Bureau following his appointment as acting director on Monday after President Donald Trump fired the agency's previous leader, Rohit Chopra, over the weekend. According to an internal email obtained by Bloomberg Law, Bessent directed an immediate suspension of the agency's rulemaking, communications, litigation, and other activities. The only operations permitted to continue are those explicitly authorized by Bessent or required by law. The The directive affects several pending regulations, including a ban on reporting medical debt on consumer credit reports that would have taken effect on March 17th, and a new $5 limit on overdraft fees. The agency has also been instructed to pause all enforcement investigations and settlements, Bloomberg Law reported. This likely means that the CFPB's recent lawsuit involving Rocket Homes and the Jason Mitchell Group for an alleged referral kickback scheme is on hold until Besant decides whether or not to proceed, or possibly to dismiss the case entirely, unquote. All right, so continuing on with politics, the Senate has confirmed Scott Turner. This is according to Inman. Quote, President Trump's cabinet is quickly filling up, with Department of Housing and Urban Development nominee Scott Turner being the latest secretary to receive confirmation. The Senate confirmed Turner on Wednesday with a vote of 55 to 44. Turner's nomination was primarily buoyed by his experience leading the Opportunity Zones program during President Trump's first term. As part of the Tax Cuts and Jobs Act of 2017, the Opportunity Zones program offered developers tax breaks when they invested their realized capital gains in projects across 8,700 designated zones. During his confirmation hearing on January 16th, Turner said he would expand Opportunity Zone programs, loosen zoning regulations and fees to encourage stronger affordable housing starts, and reduce the size of the Section 8 voucher program by enacting work requirements. Turner also said he would uphold fair housing rights and didn't comment on specific policies, unquote. So all of the headlines early in the morning on Monday, February 3rd, were that Trump was about to enact tariffs on Canada, Mexico, and China. The plan was a 25% tariff on goods from Canada, with an exception of 10% on imported energy, 25% on goods from Mexico, and an additional 10% tariff on imports from China. Now, Canadian Prime Minister Justin Trudeau and Mexican President Claudia Sheinbaum had both indicated plans to introduce retaliatory tariffs against the United States. And of course, the media was freaking out about an impending trade war, which would possibly spark renewed inflation here in the United States. However, within just a few hours, the Trump administration announced that they had reached a deal with both Canada and Mexico, extracting concessions from both countries in exchange for a 30-day delay on implementation of the tariffs. Now, this is according to the Wall Street Journal. Quote, Canada has agreed to put 10,000 frontline personnel on the border, will appoint a fentanyl czar, list cartels as terrorists, and launch a Canada-U.S. joint strike force. Mexico agreed to immediately reinforce the U.S.-Mexico border with 10,000 members of the National Guard to prevent drug trafficking from Mexico to the U.S., particularly fentanyl, unquote. So what's amusing is that before we knew a deal had been struck, a member of the press asked Trump, what concessions are you looking for? What can Canada or Mexico do in order to avoid these tariffs? And Donald Trump said, no, this is not a negotiating tactic. I'm not looking for anything specific. We're simply going to implement these tariffs because it is economically in our interest to do so. Now, that obviously turned out to be not the case because a deal was struck with both countries. And we talked about this last week. When you implement tariffs and the other country implements retaliatory tariffs, it can escalate into a trade war. And typically in that scenario, both parties lose. It causes economic damage to both countries. However, the United States tends to be the bigger party in that game of chicken. You know, the metaphor I used last week was the United States is a semi-truck, the other country is maybe a bicycle or a car or a pickup truck, right? Even if there's some damage caused to us, the other country is probably going to experience much more harm than we are. So that is a leveraging position, a position of strength that Trump leveraged in negotiations. Whether you like it or not, that's just the reality. All right, so shifting gears a little bit, we're going to talk about fair housing. So a little bit of context here. Back in 2021, President Joe Biden signed Executive Order 13988, and that was titled Preventing and Combating Discrimination on the Basis of Gender Identity or Sexual Orientation. Now, based on that executive order, the Department of Housing and Urban Development started taking fair housing enforcement action based on this new category of discrimination. However, during Trump's first week in office, he signed an executive order basically reversing 78 Biden-era executive orders, including this one. However, a Supreme Court decision back in 2020 actually expanded the definition of discrimination against sex based on Title VII of the Civil Rights Act to include discrimination based on sexual orientation or gender identity. So that specific case that the Supreme Court ruled on was related to employment discrimination, but it stands to reason that the Supreme Court would extend that definition and also apply it to cases of housing discrimination. So as of right now, the law of the land, according to the Supreme Court, is when you have a law that says you can't discriminate based on sex, that also includes sexual orientation and gender identity. So even though Donald Trump has done several executive orders related to this, you need to be careful and understand that this is the law of the land according to the Supreme Court. And beyond that, if you are a realtor, meaning if you are a member of NAR, you are obligated to follow the NAR Code of Ethics. So back in 2009, NAR updated the Code of Ethics to prohibit discrimination based on sexual orientation, and they amended the Code of Ethics again in 2013 to specifically prohibit discrimination based on gender identity. So regardless of what your beliefs are in this area, your politics, your ideology, don't really pay attention to what Trump is doing as, when it comes to executive orders in the executive branch of government, because we have that Supreme Court case precedent. And of course, we also have the NAR Code of Ethics. So, the best thing that you can just keep in mind is to treat everyone with respect. Don't discriminate against anyone. All right, so let's wrap up by talking about inventory. So after plummeting to historic lows in the aftermath of the COVID-19 pandemic due to a crazy spike in demand, primarily fueled by record low mortgage rates, we've been seeing inventory levels recover in many markets across the country for the last couple of years. As according to Inman, quote, for sale inventory bounced back in 2024 to the strongest level in nearly 5 years, with 25% of markets back at pre-pandemic levels and another 15% on track to normalize this year. And that's according to an analysis by technology and data provider Intercontinental Exchange. Inventory levels grew by 22% in 2024, with a quarter of markets, largely in the southern U.S., now back to or above pre-pandemic levels. At the current rate of growth, the nation as a whole is on track to return to pre-pandemic for-sale inventory levels by mid-2026, although a number of macro and microeconomic factors could change that trajectory, unquote. So if you're watching on YouTube, I'm going to put this graphic up on the screen. This is courtesy of Housing Wire and Altus Research. This is data from December, so fairly recent. And this is a nationwide total inventory of homes for sale. This is from 2015 through 2024. So you can see several years of data before the COVID madness of what, I say normal, but really at the time that was already historic low inventory levels based on the shortage of new construction that had happened for the decade following the financial crisis and the Great Recession. So inventory levels were already at historic lows before COVID, but then look what happened when interest rates went to crazy below 3% levels, buyer demand just went through the roof. You had all this stimulus money, easy money policy, low interest rates. And look how low inventory levels got. That was absolutely crazy. But for the last couple of years, inventory levels have been recovering, and now we are almost back to that pre-pandemic normal. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes with links to the articles that we reference on today's episode at realestatebackstage.com/episode 17. And I'll see you back here next week with another behind-the-scenes look at the real estate industry here on Real Estate Backstage.